Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, April 24th, 4:53 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market in an uptrend. Probably more proper to say it's in a consolidation because we've gone nowhere for 3 weeks, waiting for some clarification from the Fed on uh, their interpretation of economic data and interest rates, and also we've got 40% of the S&P 500 reporting this week. So the market uh, waiting for some sort of signals uh, from the Fed, from the economy, from the S&P 500 reporting companies to give it some sort of a direction. How's the outlook? Is the worst behind us? Is the worst in front of us? Reading all kind of headlines about companies cutting jobs. When they cut jobs, that means they're cutting costs. Bad for the employees, good for the bottom line of the company. That seems to be keeping some companies afloat. But every day that goes by, we'll get another card out of the deck, and eventually we're going to break higher, we're going to break lower. We're prepared for either. Uh, Reminder, we're avoiding regional banks and real estate, particularly commercial real estate. And the reaction to First Republic Bank's earnings after the close, down about 20%, is a reminder of why we're avoiding regional banks. So let's check the trend gauge over here. Leaders neutral to bullish. Short term, all five of the major indexes above their 21-day exponential moving average, so we're uptrend there. Medium term, mixed bag. The large cap index is above their 50-day, mid and small below their 50-day. Long term, also mixed. Big caps and mid caps above the 200-day, small caps languishing below. Again, this is the remainder of the fallout from the regional bank liquidity semi-crisis that we saw over a month ago now. And you'd like to say it's behind us, but when you see one of the key banks involved down 20% on earnings after being well down from their highs, you got to question that. So as always, we continue to have a lot of crosswinds hitting the market. So what happened today? Groundhog Day. Tight range again. Mixed close again, still coiling for a move, either a breakout of this range. We might see a false breakout and then a move in the other direction, or a false breakdown and then a move higher. The old Wall Street saying, from failed moves come fast moves in the opposite direction. So that's why, as I said, we're prepared for either outcome. But leaders holding up and making progress. Uh, Positive leadership slightly outweighing negative reaction to leadership. We'll take a look at that when we look at the chart. So here are the numbers on the day. Revere Growth 7, ETF Composite down 1/3%. S&P 500 gap down. Well, it didn't gap down. It opened down less than 1/10%. Tight range, closed up 1/10%. NASDAQ 100 down 0.2. Dow up 0.2. Mid caps basically flat. Russell down 0.15. Global Diversified 60/40 led by bonds up 0.12%. In-house GROTECTION up 0.38%. Our largest holdings continue to hold up well, and some of the positions we had that have been lagging the market had decent day today, leading us to do some outperformance, put up some outperformance. So let's get right into it. We will discuss, first of all, why we do what we do here at Revere. And really, we're looking here at a 3+ week, very tight range, as I just listed the myriad of uh, tailwinds, crosswinds, headwinds that are facing the market. Is good news bad news? Sometimes it is, sometimes it isn't. What we seem to know is that we want the Fed to stop raising rates, and we also want some assurances that the economy isn't completely breaking down. So far, what we're getting out of the S&P 500 has been, from earnings, has been the traditional mixed bag, about 15% reporting, some good, some bad, but nothing that's making the market break down. That might change later this week. As I said, 40% reporting, including two big ones, Microsoft and Google tomorrow. Then we've got Meta on Wednesday and Amazon on Thursday. Also have Chipotle tomorrow. and there's quite a few big ones mixed in between. But you can see here S&P 500 again, tight range. Let's go to the 60-minute chart. Very clear what's going on here. Just chopping, biding time, waiting for institutions to decide that they want to either place bets with the market and it goes higher, or we're going to go lower because we think we're overpriced. So basically, we're looking at this 30, 41.13, 41.14 on the downside, 41.70 on the upside. That is an extremely tight range, less than a percent. Day 7 of the consolidation. You could arguably go back here and say we're in day like 14, 15, since this was the follow through day and then the subsequent follow through day this week. And we tried to make a higher high the following Monday and then pulling back. But either way, it's tight. I'm using 7 because we made a higher high and then consolidated within that range this day. So there's your S&P 500. Back to the daily. Let's go to the NASDAQ 100. Uh, Still minor underperformance. The semiconductors underperformed again today, but sitting on that all-important 21-day moving average, we actually undercut it, closed back above it today. Let's go to the Dow. Dow in a tight range, also declining tops trend line. We can look to break above that if we get above 34,000, hanging around right around the ADMA note that the stochastics have crossed over from overbought and are heading down. Uh, that's a potential, it's not a positive, obviously. It's just telling us relative to where over the last 14 periods price has been, and it's going to be overridden by the reaction of the big cap heavyweights over the next 4 days. There's the Dow. Let's go to the mid caps. MDY. The tight range continues here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10-day tight range on mid caps and on small caps. Right around the 21. The only difference is below the 50-day on the mid caps, below the 50 and the 200 on small caps. And again, FRC will not help. KRE. Let's take a look at that. This has been stymied by the declining 21-day moving average. It's down about 1% after hours on that FRC. Let's take a look at the chart. Let's take a look at a 60-minute here. You can see how tight the range has been for this recently once it stopped going down, but now we're at 1269, and that is around the lows that were put in on 320. So basically going to break the lows of the past month after hours. Let's go to the dollar. UUP. Dollar down, failed breakout on the dollar above a tight range on Friday, failed at the declining 21-day moving average, another move down today. Let's see. Yes, indeed. The inverse correlation with the precious metals still intact for today, up 0.3% on gold, hanging right at that 21-day moving average. GDX hanging right at its 21-day moving average, and silver uh, hanging right around its 8 EMA. Let's look at the VIX. Not much to report here today. It gapped up. Well, it didn't gap up. Let's look at the 5-minute chart. It spiked up. Well, okay, it did gap up, and then it spiked higher, but pulled back during the day as we got quite a bit tighter on the indexes. Still below the declining 21-day moving average. A lot of people calling that we have to have some sort of a volatility event. Those things tend to happen when you're not expecting them. Let's go to bonds now. First, the broad bond index, BND, up 0.39%. So trying a bit of a trend change in bonds, you could draw this downtrend line here and see that bonds have broken above it. Track price. Okay, and then let's take a look at TLT, the long bond. Similar situation back above the 50-day, but below the 200-day. Let's take a look at yields. The 10-year TNX, if the price of bonds was up across the board, which pretty much was, you would expect yields to be down, and they were. Um, After apparently peaking on Wednesday of last week, headed lower, right around the 200-day moving average. That's the 10-year. Let's look at the 30-year, making another low after what looks like an inverse. This basically is looking like an evening star pattern where you're a strong trend in one direction, you get a candle that reverses, and then you break back below the prior. It's an ugly evening star, but it kind of is one. It signifies a change in the trend, and that's kind of what we're seeing here. Sitting on the 21 though. See what happens as the week progresses. Bitcoin Bitcoin continues to pull back after this failed breakout above the 30,000 level. Let's get to the tail of the tape now, and some key stocks that we want to report on. You can pause it. We'll hit the highlights. As I said, 40% of the S&P reporting this week. 7-day consolidation on the S&P. Closing right on the ADMA on the S&P for 3 straight days, but 21 days above the 21-day moving average. Odds of a 25 basis point hike a week from Wednesday at 89% now. Expectations still positive as long as we hold the 21. We undercut the 21 and reclaimed it on the Qs. We held it. We're about a percent above it on a percent above the 21E on the S&P 500. In range on the S&P. This big range here, this 313.68, that was the breakout level on the Qs. A big fib, 315.59. We undercut all of this, but reclaimed it by the end of the day. That's a pretty decent sign that we held the entire range, or undercut and reclaimed the entire range. Basically tight all day on the action. Oil's up, gold, and silver stocks, basic materials, staples, utilities, healthcare, and home builders continue to act well. On the downside, the dollar yields, KRE, KBE, those are the bank indexes, tech, real estate, semiconductor, software, and biotech. Portfolio changes. We trimmed TMF. This is the TLT leveraged. Um, we're underwater on this. It bounced a little bit again today. I don't particularly like the way it's acting, and I don't have a good feel for it the way I do individual stocks. It was a diversifier, and it's fine. I prefer the diversification of the small. Um, the T-bills that were in the shorter term with that don't have a coupon that pay us. We know exactly where we stand on them. We don't have to worry about the fluctuations of the NAV. We also trimmed SARK as we trimmed a profit. We trimmed 2/3 of it as Tesla started to break down earlier in the morning. It later bounced. We took some of that off the table, booked a very small gain on that, and then we bought IoT. Let's take a look at that chart. So IoT, why'd we buy this? Well, you've got the big gap up move on earnings. It has the signature that we want uh, on the earnings move, which is 1,201% volume. We want to look for at least 200 to 300%, and it was up 15%. Made higher highs the days after that. Then the market started to correct, and it corrected along with it. Put in its lows around the 21, perfect action there. Move up to this 20 area, and the high volume close, pull back from there to the 21 again. This is the key day where it broke back above the 20 area, and the 2026 pivot, the prior high, had nice volume up 7%, followed through to the upside the next day before reversing, reversed again, hanging around at the highs, not really giving much up, but today pulled back to the ADMA on light volume, 40% below average. So you can see as it's pulling back to the last 3 days, volume has been well below the volume of the days where it tried to crank higher. Decent low risk entry. We can be out for about a 7% loss if it breaks below the 21 and closes below that 20 level. So good risk reward there. Starter position on IoT possible. It's got fundamentals. loses money just a few pennies per quarter, but the sales growth of consistent 63, 52, 49, 48% is pretty sweet. So added a position to IoT to the existing positions that we have, which are Lulu, ONON, and NVIDIA, in addition to a couple of ETFs, including two inverse ETFs and a big position in UPRO. So that took our beta from 1.05 to 1.19. Bottom line, Groundhog Day, mixed close, tight range, coiling for a move, just like we've been doing for about the last 3 weeks. So let's get to some individual charts and some earnings reactions and what they tell us about the current market. Let's start with two of the big Nasdaq names that reported last week and their follow-up reaction to it. So let's start with Netflix. It was closed down 3.17% overnight, and after they reported they were down as much as 10%, but they cut into it big time. Opened up near flat, closed down 3% on the day. Volume was heavy, but that low put in the low of the gap down low, and we made a higher high each of the last 3 days. So this is a positive reaction. Post earnings, 3 days up after a gap down, sometimes gaps lower. Get rid of everybody, all the weak holders, and then it starts to be accumulated by institutions that want to hold it. You can see Netflix is forming a nice cup and handle. It's hooked up on the stochastic right as it was approaching oversold. So net after a negative reaction to earnings by Netflix, three follow up positive days back above its 50-day moving average. Contrast that with Tesla, which reported last week on Thursday or on Wednesday, gap down Thursday almost 10%, slightly above average volume. Inside day the next day made a lower low today, but closed back inside the range. So Tesla showing no follow-up strength. In fact, showing follow-up weakness. It's very oversold on the daily, but this is something we're staying away from. And it was actually one of the reasons why we bought SARK last week was the weakness in Tesla, which is Kathy Wood's biggest position in ARK-K, SARK being the inverse of ARK-K. What else do we want to look at? Some leaders that got hit recently. SMCI reduced sales outlook, blamed it on supply chain issues, whatever. Up 200%, volume above average, 186%, down 8%, breaking the 21, breaking the 50. I have no interest in this anymore after a day like today. AI was downgraded also, all the way down to the 200-day moving average. Remember the short seller here? Um, it has not recovered from that. In fact, it's just continued to make lower lows since that day. So whoever was attempting to defend the company, maybe the 200-day moving average will do the job now, but it's down from 34.68 to 17.85, nearly cut in half. This is why we have stops, and this is why we obey them. First Solar was downgraded at an odd time after the close on Friday. It gapped down, sold off early, but put in the bottom at this big 200 support level, right above the 50-day moving average, and it rallied back to just below the 21-day moving average. They report later this week. That'll be the reaction to that will be the deciding factor of whether or not it wants to go higher or lower. The downgrade was to sell, which is weird. When you see a downgrade to sell, I generally get out of the way of those. You oftentimes see something go from we had a buy on it, now it's neutral because of valuation, something like that. Those often get shaken off quickly, but when you see somebody go to sell, um, pay more attention to the negative reaction. But in this case, the gap down was bought and it closed at the high of the day. That's for solar. Next up, finally, ELF maybe putting in a break. If you look on a weekly chart of this broke an uptrend line. Let me try to draw it. One of the offensive sell signals for William O'Neill is when you break on a weekly, because you want to be using um, not because you want to be using weekly charts that show, God, the word is escaping me. I'm such an idiot. Uh, where an equal percentage move shows an equal amount on the chart. I'm having an old man moment right now as that word escapes me, but um, and ELF broke that upper trend line, and a lot of people have been pointing this out. It's also coming into the Livermore level of 100 here, and it had its first pullback day today. How was the volume? 43% above average. If you have some nice gains in ELF, uh, don't let them disappear. So that's my advice there on ELF. Next up, PD. These last two are 21 over 21 leaders that have broken the 21. So during the action today, PagerDuty below average volume broke the 21-day moving average. We always note these. Every prior time it did it, it regained it within a day. So we got to keep an eye on whether or not that happens. And then CDNS Cadence reported after hours and is down. Let's see, it was down after hours. It's down 4.6%. So that's breaking the 21. We need to see how that reacts tomorrow. And then we already pointed out FRC um, as it's down. Let's see, FRC, where are you now? FRC down 21% after hours on its earnings report. One of the key banks that had liquidity concerns, the CEO not able to tap dance his way out of a 21% move down. We'll be keeping an eye on that tomorrow. And with that, we're going to wrap it up. Why do we do what we do here at Revere? We do it to avoid big negative sequence of return hits to our clients' portfolios as they approach retirement. Uh, do not want to get your nest egg decimated as you approach retirement. We take steps to get out of the way, especially when you're below the 200-day moving average. All of these bear markets occur below the 200-day. Once you break the 200, usually that's about a 12% loss off the top, 10 to 12%. What happens after that is what distinguishes a run-of-the-mill low 20s bear market from the devastating bear markets like you saw when the tech bubble burst, when the financial crisis happened, COVID, 35% in 5 weeks, and last year, the inflation crisis down 27.5%. Uh, our vow to our clients is to not let your portfolio get destroyed. Buy these, and then we participate in the market when it turns back to the upside and acts in a more healthy manner. And if you're interested in this approach, reach out to me. The email is don@revereasset.com or my partner Dan Stewart, dan@revereasset.com. The phone is 855 Real Wealth. It's 855-732-5932. And with that, I'm going to wrap it up. Reminder, it's not how much you make in the markets, it's how much of that you can keep. And so then wrapping up Monday, April 24th, this is Don Vandenbord telling it like it is. Thanks for listening. Have a great day.